Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, I just want to go over the potential fourth trade that we called here on Alpha Commission. Of course, nobody's perfect, and so there may be mistakes or flaws in my reasoning or thinking from time to time. And while we did, of course, have three to four actually trades that may have been highly successful for you, if you did take them, I just wanted to give a little bit more of a warning on the trade that we have published in the last episode because I don't think that I fully appreciated the risk of that play. And while we are technically in profit on that trade, I want to just be clear with you guys. Nobody's perfect. Nobody can make, 100% success rate. And so if that trade does end up breaking down, then, I want to make sure that I give you the best information while we're still in profit rather than just, later pretending that I did it right or something like this, right? So, the usual YouTube shenanigans and stuff like that. It's better to just come out and say, hey guys, like I want to tell you a little bit more about the risk, and that I could be wrong on this next trade rather than just, overemphasize the fact that we had, three very successful trades where, we actually had another trade. It's just I didn't short, but there was this inverted Adam and Eve formation. And so there was the short that we were talking about potentially. And that measured move is actually what gave us the confidence to see that kind of a double bottom and then this very respectable entry and then another confirmation entry, which then played into this kind of inverted head and shoulders that had a measured move up to this, take profit point. Of course, we had a diagonal, and so we took our first profit at the diagonal resistance because that made sense. It could have been rejected down into a wedge, right? There was no reason why we had to break up there. It took a couple days for us to consolidate around 20,500 to break out and really push up. And then, of course, we would want to take our profit at the next possible resistance area, that kind of a mid-channel area, just in case we got deflected there. And finally, we got to take profit on that measured move, that descending, broadening wedge, that inverted head and shoulders. And, of course, we ended up being very successful on that third trade as well. Well, that's all good and for the past. But of course, there could be an element of greed when we start to think about a potential fourth take profit zone, which is really based upon the formation of this bull flag, which you can see the measured move here would take us into that take profit 4. Of course, there is some type of implied height of this broadening descending wedge, which could also bring us up into that location. If just depending where you measure it exactly. Let's see, what did, yeah, our take profit 3 was actually down here. We hit it pin perfect, right? Because I didn't get too greedy on that one. I was very reasonable, and we ended up hitting it almost squarely, like really perfectly, right? All of these take profits were nailed perfectly right here. We had one right here, and then we had a shoot up right here to our take profit 3. And so I'm thinking to myself, is it a little bit greedy to try to go for this kind of bonus take profit area? And is there anything odd? Is there anything odd that would make it perhaps, unreasonable? So the first thing that I want to point out is that we do have this main channel that we've been carving out for kind of months now, right? And while there is the possibility that we could break out of that channel bullishly, we have been very much rejected, 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 rejected. And, I would kind of think that we would get hard rejected just if we go by the strength of this diagonal resistance. that we would get rejected right here around 23,000, if not 22,500. So the first thing that I want to do is kind of confess that, hey, I made a mistake. I had my own principle of a diagonal descending channel, and what did I do? I set my profit, my take profit outside of that descending channel, which would actually be at support. You don't take, you don't take your profit at what would be flipped into support, right? That wouldn't make sense. You take it at resistance. So the first thing I need to do is lower that. Okay, I can make that skinnier and I can lower it. So that's the first thing that I need to do. And that's a mistake that I made. And I'm realizing these things on my own. There was something that was just nagging me about this. So even if we got the measured move to our channel resistance, we would expect to be deflected there. So I shouldn't tell you to take your profit outside of that channel. I should tell you to take your profit inside of the channel, right? So if we end up coming into this area, over here, it's hard to draw these boxes. I think I should just I should use one of these boxes that can be rotated like this. There we go. So really, this is the area that I should have been telling you to potentially target as a bonus take profit for area. And and to expect that this measured move might end up being limited by this diagonal resistance. And then, of course, the second consideration that I'm having here is this concept is partially built upon the idea that we have an Adam and Eve formation right here with a measured move that would have brought us into that area, right? So this, you can see this Adam and Eve. The measured move for it would bring us, approximately up here in this area. And, if we were going to, consider that this perhaps was an inverted head and shoulders when we were first like forming this area, then that would also have a, potential measured move in that area. But both of these are pretty unreliable. And I'm going to tell you why. First of all, I hate I hate these inverted head and shoulders after a huge fall to the downside. They're just notoriously unreliable. And so, when I think about it, I think about it as a descending, broadening, wedge, which makes sense. And then the measured move is just from the breakdown, which, we pretty much got into that area and which would actually suggest a take profit here. It would not suggest up here, which the Adam and Eve and the inverted head and shoulders would suggest. And so right away, just based on my own principles, um, the wedge measurement is actually the better spot to target rather than the Adam and Eve or the inverted head and shoulders, which I consider to be kind of a fake inverted head and shoulders to begin with. And then the second point is about this Adam and Eve formation. It just doesn't sit well with me. And it doesn't sit well with me because if we go to the CME chart, it doesn't exist on the CME chart. The professional exchanges didn't print that dip to 17,000 or whatever it was, right? So how can we have an Adam and Eve formation, right? If if it doesn't exist, if it doesn't exist on the professional exchanges, right? Well, okay, maybe the 24/7 exchanges can trade on that, using their 24/7 exchange charts on the weekends because the professional exchanges are closed. And so, hey, maybe we are going to get that breakout out of this channel, and maybe that measured move really will play out, right? And that maybe the 24/7 exchanges are going to take advantage of the fact that the professional exchanges are closed in order to break us out of this channel that we have just been locked in for months. But should I recommend that as a trade? In my mind, there's something irresponsible about that. And in order to be a responsible trader, you still want to limit yourself by resistance and take your profit at resistance. You don't want to just get into the politics of 24-hour exchanges versus professional exchanges. So yes, maybe the 24/7 exchanges, the whales, the market makers, the big institutions that can manipulate things in the middle of the night might end up just sending it, right? But if they don't, then it would have been highly irresponsible to set a take profit up there rather than down here. Now, the next point, which I should have given more consideration to when describing this trade setup, and at least in terms of the risk of it, is that of course it doesn't play well with the fractal that we had going on in the previous setup, which is a very clear analogy to our current setup. So what do I mean by that? What am I talking about here? What I'm talking about is this area right here, where we had this kind of pop up after this kind of chop, right? We had this up thrust, this chop, this up thrust, and it did not make it to the top of the channel. It actually ended up being a fake out, and then the second attempt is what hit the top of the channel before breaking down to the bottom of the channel, right? And in this way, we're traveling through this channel, right? And so if the current setup is a pretty clear analogy to the previous setup that we had before that big drop the other week, um, should I recommend that we're going to actually go to resistance right now as opposed to potentially and perhaps more likely playing out this type of fractal, which would correspond more with the dates surrounding the CPI data and the Federal Reserve decision, right? So I think that perhaps the markets may want to just buy a little bit of time before they make this hard decision to go up or down, right? Depending on what the CPI data and the Federal Reserve determine. And so why would I just kind of take it on faith that we're going to do something different than what we did up here? Well, one of the reasons I could consider that perhaps is that let's see. Did I? Where's this one? One of the reasons I could consider it is that we actually have a slightly different setup on that previous area than we do right here. And what do I mean by that? We have a kind of a diamond pattern, right? We have kind of a diamond pattern printing over here, which ended up just having a hard breakdown. Okay, but what do we have going on over here? We have, in my mind at least, a much more clear bull flag formation. And so the measured move of the bull flag is going to be something like that and maybe to the top of the channel. So from my perspective, it is a better bet, to take this trade than it was to take it over here. That diamond trade, as soon as it broke down, you could almost expect it was going to, test the bottom of the range. It was just, you know, these things can just break down brutally. But for a bull flag, a lot of times you might get a little fake out, right? You might get a little fear of God in you before they pump it back up. And then you end up having the breakout to the upside. So in my mind, this is why I didn't really compare them in too much detail. But you see these yellow lines I have drawn out to where we currently are and to where we were over in that pattern. Here's the problem. If we look at the indicators, we got similarly overburnt, right, on the chart, and now we're breaking under the EMA on this kind of volatility, right? If I look at the Stokes, we are turned down on the Stokes, and all of this is on the 6 hour because this is where I'm finding the analogy to be most comparable, but on the 6 hour, our Stokes is just breaking down and it's actually accelerating. When I made the previous video, we were having the potential to turn up, but this thing is actually just accelerating to the downside, and the volatility is going with it, right? And then if I look at my oscillators are turned down. They used to be turned up. They were almost vertical, when I was first thinking about this trade setup. But now they're turned down in a very similar fashion that they were over there in May, when we had that just massive dump. And then, additionally, you can see that the BBWP is also orienting itself very similarly after bottoming and then topping, bottoming and then topping a bit, rounding down. The curve, suggests that, anyway, it's crossing its EMA to the downside, similar to the other one. But here's a real kicker. The MACD just freshly crossed to the downside. So not they didn't both cross. This can be undone, but this is very risky. Okay, so after this type of a formation and then a cross, if the next one crosses, it's almost guaranteed that we're going down, right? And here you can see that the RSI also crossed its EMA to the downside. And when that happened, of course, we plummeted last time over here. So all of these setups, again, it was right there with the MACD as well on that previous one. So all of these setups are just telling me that the momentum is potentially to the downside, even if we do end up popping up because maybe there's some whale games or shenanigans in the market. There is the possibility to pop up, but the momentum suggests otherwise. And just last consideration here is, we do have the money flow crossing negatively for the first time, and the ADX is actually losing strength, while the money flow is actually decreasing. So that just suggests to me that we basically have the same setup as the previous one. And, whether we use a structural analogy where it's very clear that we have a very similar kind of setup here, just would I want to gamble on this? Now, guys, this video has been pretty long. And, I mentioned don't buy at the middle of the range. I mentioned only buy at support. And if you did buy at support, you're still, like 1% up, right? So if you did 10x or you did whatever, okay, you're in profit. But just understand the risk that if we do break under, that area, that we could potentially come slamming down pretty hard. And so while so far it's a successful trade, be aware that in order to flip these things bullish, we actually will need to capture this area right here around 22K. And the only way all of these indicators are going to flip bullish is if we capture 22K. And guys, if we break down below this kind of 21K area, then most likely we're going to visit the bottom of at least this channel, right? Or at least this diagonal support. And then potentially, we kind of run up like this before killing over, or maybe breaking out, depending on how the news is, right? So, yeah, that was a very long-winded way. It was actually more time spent kind of covering the risk and trying to be very transparent about potential flaws in my thinking for the last setup than I actually spent on the trade setup itself in the previous video. But that just goes to show that, you know, you can make mistakes. You can make mistakes and you can take bad trades and be a little bit higher in risk than you thought that you would be. But if you're thoughtful and you review your trades, you can catch those mistakes before it ends up being a serious problem. And it also shows that if you stick to certain principles, for example, buying at support, not buying at the middle of the range, then you can actually save yourself a lot of headaches, because the fact that we bought at support, right, of this flag meant that we're in profit right now. Whereas if you had just bought in the middle of the range or right up here because you thought you were breaking out, or if there was a little wick that poked up and you bought the wick instead of a closed candle, which is what you should be buying, like a 4-hour closed candle or an hour closed candle or something a little bit more substantial than just a little wick poking out, right? Uh, then you could be in a huge loss, or you could be in a kind of a moderate loss if you were doing like those type of trades that are a little bit more risk prone, as opposed to following clear principles of buying at support. So technically we're in profit right now, but I'm just pointing out, guys, like I'm human. I'm probably going to make a bunch of mistakes, and I want to correct those mistakes before they become serious. And so it's better to correct that mistake while we're in profit and take whatever profit you can on this trade and wait for perhaps a confirmation above 22,000 before getting into this type of a long, because all of the setups for all of the indicators suggest the possibility of a serious breakdown that has an analogy to this candle that just dropped, straight down back here, right? It just dropped straight down, right? And so that was very relentless. And so if you're using leverage, that would not feel good. And if you don't have your stop losses in place, that would not feel good. So I'm warning you guys, please examine your risk. Even when you take a trade, always make sure you do your own review of the setup and that you take a look at those indicators. And then, even after you take the trade, double check them to see if you overlooked something. Because while we're trading on trend, we're trading on trend and patterns right now. We're not necessarily understanding what's going behind the trade in terms of the indications. And so even if we just kept it simple and used the MACD and the RSI, this wouldn't be a good setup, right? You have hidden bearish divergence right here, right? Why would I take this trade long if I have a MACD crossing to the downside and hidden bearish divergence on my RSI, right? That's a mistake. And then add to it, that we were overheated and that we're headed to the downside. The Stokes is headed to the downside. My oscillators are headed to the downside. My momentum oscillators are headed to the downside, and the money flow is headed to the downside and about to cross negative, where it just doesn't look great to me anymore. And so I'm exiting this trade, obviously in profit, but sometimes it's better to take a little bit than to lose everything. And additionally, or you can just bring your stop loss up to wherever we are right now and just let the market like stop you out, right? But otherwise, I would much prefer to just see some confirmation above 22,000, in which case our Stokes is going to flip around, our MACD will will uncross, and the RSI will, likely have been pumping back up by that point. But do I think those things are likely? Maybe not. It would probably depend on whales and whatnot. But again, just wanted to put that out there. Everyone has some blind spots in their trades. Everyone, can make mistakes, and the goal is to correct our mistakes before they become problems, because then, you can actually end up, in profit or even on a win. Even if you made a mistake, you can always have a chance to correct that. All right, guys, that was your alpha for the day. Stay safe and happy trading.